Hello. We are still the Ways and Means Committee, and it is tax day, April 15th, 10:15. And we are continuing our work on an act relating to income tax brackets and investment income with Patrick Titterton from the Joint Fiscal Office. The floor is yours.
So Pat Titterton, Joint Fiscal Office, Madam Chair, before I start, a quick question. To continue the thread, so my slides, I start talking about the income tax bracket.
Oh, yeah.
And then with wealth proceeds.
Let's go backwards.
Let's go backwards. Okay.
Or not backwards, but halfway and then back.
Just to continue everyone's thread of thought.
So confusing.
All right, so you'll notice that a lot of the words on my slides are going to be pretty familiar from what you just saw from Kirby. I did hear a few questions as we were going through, and hopefully can give you my perspective on some of those as well. So as Kirby mentioned, at the federal level, so we'll talk about just like Kirby talked about at the federal level first, we're going to do that again. The federal level, the net investment income tax was enacted effective January 1, 2013. And as mentioned, it was intended to in part fund the Affordable Care Act. Federally, this money does go into the general fund, so it's not dedicated, but it was sort of conceptually meant to pay for some of those costs. It is a surtax, and just when we're going through this and thinking about that concept, I've been thinking about, and I think it's accurate to say that really personal income taxes and this net investment income tax are sort of two different tax types. So while you're looking at a lot of the same types of income, they're not, you shouldn't sort of blend them together too much conceptually. So yeah, as a surtax, the Vermont investment proceeds tax would be additive and not in lieu of personal income taxes. So that's where the surtax concept comes from with that. Yeah, and so federally, the tax rate is 3.8%. And I have a couple other examples showing how that sort of lesser of investment income or MAGI works. But the MAGI thresholds that an individual needs to be over are 200,000 for single, 250 for married filing jointly, and then half that for married filing separately. And so really these are just the thresholds of all the types of income that you have that determine if we're then going to do the math to figure out how much tax you might owe on that invested income, right?
I appreciate that sort of process map, kind of.
Yeah. So yeah, it's a two-step process. First, figuring out if you're required. Second one, doing that lesser of math to figure out what's owed. And so this first example is the same one Kirby showed you, but so in one instance, you have a single filer who has 50,000 in that net investment income.
I'm so sorry, but can you say that thing about sort of the threshold to get to the threshold again?
Sure.
I think it will be helpful.
Yeah, so
We're all on the table.
we were just looking at the income thresholds, so those MAGI thresholds that on the federal level and in this bill determine whether you are subject to the investment income tax. And so what I was saying is that this is sort of the first determination of whether we then need to do the math to figure out how much you may owe for this tax. So this is really, these numbers represent all of your income. So regular AGI, everything that goes into that, wages, tips, salaries, capital gains. So that it's just everything. And that's just the threshold to determine whether we take that next step of determining how much you may owe for this tax. So if you're below these levels, considering all of the income you might have, you would not be subject to this tax in any way. Okay, so the two examples. So the first one is identical to the one Kirby shared. It's an instance where a single taxpayer has $50,000 in net investment income. So that's the dividends, interests, all those things. But their MAGI, so their total income is 300,000, which is $100,000 over that threshold. Remember, so for single filers, it's 200,000. At 300,000, they're 100,000 over the threshold. So the next question, or next step in the math is what's smaller, being 100,000 over the threshold or the 50,000 in investment income? Obviously, in this instance, it's the 50,000. So that is the dollar figure that you're going to apply that tax rate to figure out what the taxes owed are. Another instance, sort of the inverse situation, a single taxpayer, again, $50,000 in investment income. But their MAGI is 225, which puts them $25,000 over the threshold. So since $25,000 over the threshold is less than their total investment income, that's what the tax rate is going to apply to. So two different situations here, both with the same amount of investment income, but you can see that the individual with the lower income has the tax rate applied differently. Is that?
Representative Brennan,
And this works whether or not they withdraw that 50,000 and use it to go to Vegas or whatever. If they leave it in the bank or leave it in the stocks or leave it where it
so those
is.
are two different things.
Yeah, so there's a difference here between, I think maybe you're getting a little bit at realized versus unrealized gains, right? So if you own a stock and you never sell it, then it's not going to be subject to this. I mean, it might have dividends if it's paying out over time, but whether the value of the stock ends up getting incorporated into the calculation of your investment income, that would require capital gains, which would require a selling event, right?
Yeah.
Once you sell it, yes, you can go to Vegas with it if you want, but the state is going to say, or at this point, the federal government's going to say, well, actually both are going to say that was income that you realized. So the triggering event there is the actual sale of the stock.
Okay,
So real to have that income, yeah.
but if you don't sell it and you just leave it accumulating more,
Mhm.
then it just, you don't owe anything?
It's unrealized gains.
Okay.
It's the same as you bought a home. Maybe I'm going down a bad path. But let's go anyway. If you bought a home and you live in it for 30 years, and then you go to sell it, you're going to have capital gains on that home, even though you had it for 30 years and weren't paying income taxes on that, the ownership of that asset.
Unless you turn it over.
That's why I was thinking maybe I was going down a dangerous path.
Representative Odie was able to join you on the dangerous path.
Yeah.
It's like that.
I live on the edge.
An adventure seeker.
It gets more fun as the older you get.
Representative Brannigan, do you have clarity from Pat on what you were asking?
Yes.
Okay.
If the house you buy is a building you end up using for business. Like, say you have a building across the street from where you live, you buy it and turn it into a pottery place where you sort of do that and it grows into a big successful business. You sell that business or something happens and you liquidate all that money that how does that work? That's all taxable, right?
Well, if you sell it for more than you purchased it for, then you're going to have capital gains that you're realizing at the point of sale.
We're still talking about capital gains. Yeah, okay. Okay,
And then there are other things with capital gains related to housing purchases that are,
yeah.
yes, but we're not gonna get into that. Representative Pickett.
Well, I was just gonna say too, even though the capital gains is calculated after you can take off certain deductions for improvements or whatever you do over those years, right? Yeah. Okay.
And then there's even more things. on
Totally
top of
different
that.
between what you bought it for and what you sold.
There are piles of exemptions related to capital gains and houses specifically that, make it quite unusual when a capital gain is realized from the sale of a house.
Would it be fair just to say you have to actually get cash in your hands in that taxable year to start to have any of this kick in.
I think so.
Yeah.
That's right.
That'll be
So
fun.
the triggering event there for the capital gains is the sale of the property. Other instances, there's other types of investment income too. You could hold stock that's issuing dividends on an annual or quarterly basis. And that counts towards investment income, right? But if you're just talking about capital gains, you need to have the sale as the triggering event for that to be considered income.
So I'm thinking the people in my district are, a lot of them that are not wealthy. Most of them are not wealthy. They would not fall into this, but they might have 1 year where they qualified for all of this. And are we, boom, zapping away their money that they counted on for retirement? The lady who's running the pottery shed.
So, I mean, that's a phenomenon we do see in the personal income tax world where people will show on paper a large amount of income in a given year. And, for a lot of people, that can really just be kind of a 1 year blip because they had a triggering event like selling their business, which they had built up over time as sort of their retirement, but they did end up selling it, which is going to show a lot of income for them in that year that they sold it, right? But the year after, their income might be much lower again. So
How can we protect them from that 1 year?
So I think we can figure that out more, but there are in the language that Kirby went through, right? There's a bunch of retirement investment mechanisms that are not included in that. So IRAs, for instance.
yeah,
And so like your average retiree, we're not talking about here.
But that doesn't cover the business, so this usually starts.
It depends on what you do with the money. Let's go to Pat.
sure. So
I feel like to some degree, I think we're entering into I think it's really helpful to think about hypotheticals, and I worry we're entering into flashcard hypothetical territory. And so, just want to make sure we're understanding the underlying concept before we start testing it too much.
Sure. So just a reminder of things that are included in the federal version of the investment income tax. This is the capital gains, dividends, taxable interest, rent and royalty income, that passive income from investments, and then again, business income from trading financial instruments or commodities, and then the taxable portion of non-qualified annuity payments.
The financial instrument commodities, is cryptocurrency included in that area?
I believe it would.
And is there anything that is not included? That could be,
Financial,
yes.
not included financial instruments. I'm not sure that question might be too broad to answer, really. I'm not sure.
We covered pretty much everything.
I mean, there's a lot of different types of financial instruments, unless there are certain certain preempted exemptions at the federal level. That means that we can't. And so, there could be some situations in there where things are not included. I'm actually not sure if there is a fleshed out legal definition of financial instrument, but we can check on that for clarity if needed. Equally important, so all these things on this list are going to go into the MAGI calculation, which, again, is what determines if you're subject to this tax in the first place. But these are all those different types of income that are not included in the federal version of the investment income tax. So again, wages, social security benefits, unemployment pay. I know a question did come up about military retirement pay, whether it's included. So military retirement pay is going to be included in an individual's AGI. On the Vermont level, what we do, so our starting point is AGI in our tax code, right? So on the personal income tax side, we do have that exemption, which comes in below that line. So it is excluded from taxable income on the personal income tax side. When we're talking about this particular tax, that income is going to be included in just figuring out whether you meet the threshold to be subject to the tax. But that income in and of itself is not going to be considered investment income. So it does play a factor in determining whether you're subject to the tax, but it does not play a factor in terms of what being directly taxed itself. If that makes sense. Okay, so the Vermont investment proceeds tax largely piggybacks on this federal version. It's similar in the sense that it's a surtax on this investment tax. It has a similar base, but as Kirby walked you through with some of the add backs that are proposed in the language, it is a little bit more expansive in terms of the types of income that it pulls in compared to the federal version. And again, it maintains that structure of taxing the lesser of how much you're over your MAGI or the amount of investment income you have. So those parts are all similar, and the thresholds in the language are the same as they are federally. And it's also drafted in a way that it does not inflate with time, like the federal thresholds do not inflate over time. But there are some differences. The tax rate's 4% instead of 3.8. Actually, I guess I'll take a quick step back and I'll say ITEP did write a report on, it was called Net Report to Wealth Proceeds Tax. And they did their own estimates for all 50 states if they were to implement it on 1, 2, 3, 4. I think it might have gone up to 8% or something like that. Just different iterations. So the language of this bill is largely, I think, fair to say, structured on what they had put forth in that report. So the add backs that you see here are things that you can also look to in that report to help wealth proceeds tax by them and not the NIT or the VIP. So some of those things that we're adding back, so it includes all the income types that the federal investment tax includes. But it also adds income from state and local obligations outside of Vermont. So this is that Massachusetts local bond. And we do the same thing in Vermont. We add back interest earned from funds from states outside of Vermont to personal income taxes. So there is some consistency there in terms of adding that back. So it also includes gains from qualified small business stock excluded under federal law. I'm sure you all remember from the miscellaneous tax bill, which was just in here, that those capital gains are exempt from taxation at the federal level. And so that, again, one of the reasons that this committee took up language on that particular provision, that's something that was flowing through on the personal income tax side. But just a reminder that this income is fully not taxed at the federal level if you meet the holding period requirements of 5 years or more. So the language is proposing to include those capital gains in the calculation of investment income. It also includes adding back investments for opportunity zones, the disposition of property held in trades of business not subject to the NIT. I took this to be kind of the active business sale, or like being involved in active business, which under federal NIT, if you're not actively involved, would be passive and therefore included.
Back to opportunity zones. Has there ever been any evaluation in Vermont of the impact at the state level on total revenues of the opportunity zone?
Not to my knowledge, and actually
Very mixed at the federal level.
Yeah, and actually federally, when these were first implemented, there was no reporting requirement. So to my knowledge, there hasn't even been a report done on this at the federal level. I do know with the recent expansion, they are going to start requiring some reporting at the federal level. But yeah, to my knowledge, I don't think that it has been done, and I don't know if there's a lot of publicly available information even on that.
Meaning you couldn't even evaluate the net impact in Vermont because we don't collect data.
We don't collect the data, and I don't know if it's comprehensively collected elsewhere. But I do know that the 8.1 included some reporting requirements going forward for it. So the net unrealized appreciation in securities of an employer, corporation, and certain retirement accounts. This gets at the questions that were being asked about ESOPs. So I actually used to work at an ESOP for a little while. And basically how it gets set up is the company will establish a trust, which will purchase the shares from the company and sit in the trust. The plans are set up, or for me it was anyway, I don't know if there are some instances where it's different, but the plans for the employees were set up as defined contribution plans. So similar to what you'd see for like a 401k or deferred compensation. So the way it worked, where I was anyway, each month the employer would take some of my paycheck and put it into this account, which would then be invested in the stocks for that company. They also had the option of contributing on a quarterly or annual basis. And, there's also, I think they were called purchasing periods, where if you had the wherewithal, you could deposit more money and buy more of the company stock. But so every year the company would, where I was working, I have an actuary establish what the fair market value of that stock was. And so you had your cost basis on all the stock being issued, and either when you end your term of service there or retire, what the trust then does is buys that stock back from you. So then it kind of rolls over into a traditional like kind of IRA. But sort of the tax advantage status that is currently there for plans like that is that similar to an IRA, well, as you're investing in that company's stock over time, you're going to have those unrealized gains, right? And when you go to sell them, because it's a tax advantage account, those gains are not taxed like they are similar to an IRA. You can have as much capital gains in the IRA as you want. The only point of taxation is when you start taking withdrawals. So if you remember, withdrawals from 401ks, IRAs, which Kirby was showing you earlier, those are not considered investment income. But what this is saying is those capital gains that were sheltered in this defined contribution plan would be included in your investment income tax calculation. Does that make sense? Okay. And that was how where I was working was structured. I don't know if it might be a little different in other places.
Representative Bodie.
So, okay, written this down, I've been processing it, but does that put you at are you on par with people who don't have, well, first of all, are you required to buy, to put money in that defined contribution plan and buy stock in that?
So, the enrollment process is like any employer who offers a 401k. Typically, you can enroll or opt in. And so, okay, where I was working, I would put some of my paycheck in, and I had the option of doing your regular Vanguard targeted retirement date sort of mutual funding type thing. Yeah, I could put the money towards that. So within the retirement account, I could have the option of putting the money towards, regular retirement investments that you might have in a 401k or IRA, or to put it towards purchasing more of the employer's stock. So there was some flexibility for employees in that way. I don't know if that's true at every company that has these types of plans though.
I'm trying to get at.
Yeah.
If you were an employee and the only thing you could do would be to purchase the stock in the company that you're working at. So then I don't want them to have to be disadvantaged vis-a-vis others who aren't required to put all their money in
And I guess my knowledge goes as far, but I don't know if there are situations where you're only allowed to buy the employer's stock.
Okay, so
Yeah, that wouldn't,
if you, I mean, we could write something that said if you were only could invest in that way, that you would have no, you wouldn't be harmed.
I just don't know if that situation does exist.
Yeah.
or could be legal even.
Yeah.
So it's. a choice.
Let's, yeah, but let's wait to problem solve until we actually fully understand the bill.
Well, I may forget.
That's why we have
Mine is right
paper
here.
and pens and.
Well, I've written this down. but-
Great.
Okay,
And I appreciate you flagging it so that we will all remember it as a problem.
good. That's all.
Yes.
That's all.
No.
So the other piece was just the non-grantor trust that Kirby had talked to you about was the last thing in there that's added back on. Looking at other states, there is one other state that has a specific investment income tax. Minnesota has a net investment income tax. It is not structured quite so similarly as the federal version. It's 1%. It includes everything that's in the federal base, so the capital gains, dividends, those investment income types are the base of this, but there's none of the calculation on lesser of investment income or MAGI or like exceeding the threshold. Their version is structured as investment income over $1 million is taxed at 1%. So there's no lesser of, and the threshold is specifically only in investment income. So that's the only other state that has one. It's still very new there. I don't know if they've actually, I think they will soon have reported results because again, it's very new there. So it will be interesting to see how that sort of rolls out. But that's currently the only other state that has this genre, I guess, of tax, this surtax on the investment income. And so thinking about Vermonters who might be subject to this tax, this is from an IRS report from 2022, I think it was. Tax year 2022. This is showing for Vermont taxpayers who are paying the federal NIIT, how many are in these AGI buckets. So yeah, so there's roughly 180 in that 100,000 to 200,000 bucket, all the way up to 970 in a million plus. Overall, Vermont in that year, about 12,000 Vermonters were subject to this federal tax. So, because this bill is contemplating using the same income thresholds, the MAGI thresholds to determine whether this tax is applicable to you or not, this would probably be a good sort of benchmark to thinking about how many people might be subject to this tax in Vermont and sort of what the income distribution of the taxpayers are. Obviously, you can see here, the biggest sort of count of taxpayers falls in that 200,000 to 500,000 range. That kind of makes sense to me, right? Because there's just going to be more taxpayers in general in that bucket than in the million plus. But, and also similar to what we see in personal income tax code, and actually when we talk about the new bracket, we'll see in some other slides, the majority, so 56% of the federal investment income tax was being paid by those individuals earning over $1 million. And if you combine that with 500,000 plus, that increases it to about 80% of the tax payments coming from those individuals earning 500,000 and up.
I asked another question about Minnesota.
Sure.
How long has Minnesota been doing this? And why aren't other states jumping on the bandwagon to do what we're possibly going to be looking at?
I think Minnesota's either in their first, maybe second year of having this tax.
I think they passed it the first year of last biennium.
Okay. So they're just.
They might have had a like delayed implementation date.
Um. I am not currently aware if other states are currently contemplating this tax type. That's not to say that they're not. I'm just not aware.
I would offer, so I go to a lot of tax conferences with other tax chairs, both like fully nonpartisan ones and more partisan ones. And I think it's just like, this is a super niche tax. I hadn't ever heard about it until this year. It's sort of like deep in federal IRS code, the fact that it can be so easily applicable to state code. It's interesting. I don't, yeah.
I'm just trying to make sure I understand a very basic thing about this. So is there a situation where you have to pay the federal tax and you have to pay the Vermont tax? So is there potentially a bucket of income that someone has that is taxed as regular income? Because it's within their AGI, then it's taxed again at the federal level at 3.8%. And then there's another 4% at the Vermont level on that same bucket of income. It's basically eligible for all three of those taxes.
Well, and the personal income tax in Vermont. So
That's what I mean. But so it's taxed as personal income tax
Yeah, so-
because it's part of the AGI, like you're.
it's a surtax, so it's going to be additive. The taxes paid is going to be additive to the personal income tax code.
So potentially it's whatever your personal income tax, wherever that falls and your effective income tax rate for your personal income tax plus potentially 7.8% if it qualifies for both the federal one and the VIP tax.
Are you shaking your?
And the other,
Yes.
yeah, it's a surtax. The other thing I would say, Representative Page, is that I think there's sort of a growing interest around the country in taxing unearned income at a higher level than earned income as the wealth gap has grown so much in the last few years. And earned income has grown much less quickly than unearned income. To make sure that our tax code is keeping up, and this is one fairly straightforward way to do that. Without having to like state level tax departments to try to create new mechanisms. This is a way of doing something that is sort of understandable to taxpayers in that category.
I guess if I was in these categories.
Yeah.
I would look differently about residing in Vermont,
Mhm.
or I would go elsewhere where
Mhm.
I wouldn't be taxed.
And we're going to take some testimony about that very question tomorrow.
Which is just, I think to your point, man, it's sort of like a modernization of tax code because how folks are bringing money into their own household is changing over the years. 50 years ago, you get a good union job, that's enough to support, a family with 2 kids on one income, and folks are just using money and financial tools a lot differently than they used to. And I think that in order to have long-term financial sustainability for the state, we have to modernize how we're looking at all kinds of income and how we're looking at bringing taxes in.
Great. So our estimate for this is just shy of $60 million on an annual basis. Obviously, as investment income grows over time, we would expect this dollar figure to grow over time, the revenue figure, I mean. And just noting that the implementation or the effective date for this tax is a year out, so for tax year 27. So what that figure represents is fiscal year 28 revenue. And as we were just looking at the other table, looking at roughly 12,000 individuals who would like, or taxpayers, or tax returns. That can obviously be more than one person, but roughly 12,000 tax returns likely would be subject to this tax in that amount. And that's everything on.
And again, where would these funds go? Would they go in our general fund?
Yes, the language is written is for the general fund.
And right now, that's how it's written. That is something we can absolutely work on. As long as it's a tax credit. If it was appropriation, that would be the appropriation. Representative Odie.
So, like 12,000, how many, can you just put that into context, Kim? So there's how many tax returns filed in Vermont?
Oh, over 300,000,
Over 200,000.
300,000.
300,000.
We're gonna, wait, sorry, Representative Odie, I have had a sneak peek of Pat's presentation. And I think we're gonna get sort of a better sense of the spread of income taxpayers. And that might be helpful. In fact, we've jumped right to that slide.
So about 330,000 tax returns were filed in 2024. And this is specifically, these are just personal income tax. This is part, I have another section of this presentation that's all about personal income tax. So remember when I started trying to keep these two tax types separate in your mind, but this table is referring to personal income taxes. Guess I'll pause. That was what I had for Vermont investment proceeds tax.
We're gonna go to, let's go to Representative Holcomb's question and then let's do,
Happy to see to Kirby.
I mean, the language on the income tax. is pretty straightforward, right? So let's then do the rest of your presentation and then go to the language.
Okay.
But first, Representative Holcomb's question.
I'm sorry, the broken record, but there's some places where the number of returns shrinks again. And has anyone ever run this against things like eligibility for subsidies on the exchange, things
The
like that?
benefits with conversation. So the last analysis that was done on that was done by Deb Brighton. So it's been a number of years, although you think it's something we are maybe contemplating looking at as part of the 10-year tax study, which we'll be doing this summer. But it is very complicated analysis. I will add.
I totally hear you. I've just heard from so many people who've declined the income to retain eligibility for various healthcare.
I can't wait to get that tax study. That'd be great.
Yes,
But if you say you might put that in the tax study,
It's something we're going to be looking at.
that means you're looking at it, sort of getting studied or even think about it.
Let's not get too deep into the study right now. I really want us to finish
All right.
looking at this whole thing by noon. Representative Holcomb, do you want to talk more about the healthcare cliff that you were just talking about?
I just know that there's several places where there are very significant cliffs where your $100 increase in salary could give you an additional $40,000 of expenditure on healthcare. And so people are choosing healthcare over compensation in ways that may actually be playing out in some of those numbers right there. That's all. I mean, and there's other cliffs as well. I'm hearing it now about childcare.
Okay, so we are going to fully transition into talking about personal income tax and the other language that is also included in this bill. I'll have the full bracket earlier, but for reference, what the language is doing is establishing a new top marginal rate at $586,000 of AGI or of income at the married filing jointly rate filing status. It's a little different for single head of a household and other one, but just as sort of the reference point, it's setting that 13.3% new marginal rate at that income level. Where did that number come from? The tax department does publish tables very similar to this, but instead of breaking it into AGI income brackets where it's sort of just like 100,000 step here, 100,000 step there, they actually do it by percentiles. And what that 586 refers to is what the first percent, the 1 percentile was for tax year 2024. So in a sense, this level is representing the top 1% income earners amount in the state of Vermont. And that effective date on there is not correct because just like that we saw with the investment tax, it is set effective for January of 27, so affecting fiscal year 28. It's not retroactive to tax year 26. I apologize for that. So, in Vermont, the top 1% of returns at that AGI level represents about 3,300 tax returns and about 8,500 individuals. So naturally, the amount of returns above that level are 1% total returns. They represent about 17% of all Vermont AGI. And they also represent about 30% of all net Vermont personal income taxes paid. So the 1% of the returns making up about 17% of all income in the state, also making up about 30% of net Vermont taxes paid. And I pulled the tax, unfortunately, the department changed their format. Well, they changed it to something more useful to me right now, but prior to 2018, they had the table in deciles, so I wasn't able to get more historical percentiles. I know. But this is just showing you a few different iterations of what the first percentile has looked like in Vermont in the past. So you can see starting in 2018, about 400,000 and above would have made you considered in the first percentile of Vermont taxpayers. But by 2024, the income or the AGI you would have needed to be considered in that top 1% was about 586,000.
Representative, yeah.
I'm gonna say, we'll find out tomorrow, but I'm hoping that we would find out, what do we know about this 1%? What age they are? Are they retiring? Are they running a business and the business is really here, it can't be moved, that kind of.
There's a great brief from Joyce Manchester, JFO website about age and wealth and income.
It's on state too.
It was, she wrote it last year. Last year or was that 2 years ago? It's last year.
And with the population issue brief,
No, the income wealth issue brief,
2 years ago.
2 years ago, and that had a lot of age stuff in it though. The age brief is older, right? Anyway, and who those people are is something that you can certainly ask people tomorrow.
And that's what it's called, age
Kind
and
of
wealth.
important to know.
No,
I'll send it around.
Sorcia's gonna find that issue brief. It's a brief. Quick read, yeah.
So you can see that over time, the income required to be considered in the top 1% has been increasing. But you know, as a share of total Vermont AGI, the percent that they've made up has been relatively constant, somewhere between 15 to 17% of Vermont AGI is sort of been the norm for the amount of total income that this group represents. And then, you know, the same is also true with the percent of overall taxes paid on personal income by Vermont residents. So in 2018, they represented about 27% of total receipts. And then by 24, they're around 30% of total receipts. That's gone up and down, as you can see in this table a little bit from year to year. One thing that did sort of jump out to me in looking at this, and maybe some of you have already noticed, is what was going on during this little period of COVID. There's clearly a very significant run up in the amount of income that you needed to be considered in a top 1% of you know, income for Vermont taxpayers. So
That's what happened, Pat.
a lot of fiscal stimulus, a lot of increase in income at this, you know, there was a general increase in income across the board, but clearly, you know, to be considered in that 1%, the the jump was pretty significant. And you can actually see in the years following that, sort of base shift has been durable. At the time, we weren't sure if it's just the general run up in personal income tax and sort of income in general and personal income taxes paid in the state of Vermont was being sort of skewed by this really strange economic environment we were in during COVID. But you can see here that, and then if you look at some of the other historical tables, a lot of that increase in income has been relatively durable at the time.
Would it be fair to say that it's because people are making more who are making under that top 1%? And that's why they have to be making.
I wouldn't say that a takeaway here should not be that it's just the income for this cohort that's increasing. There were income increases sort of across the board. So, but just to be considered in this, 3,300 cohort of tax returns, that was the dollar figure, sort of the cutoff.
All right, so let me ask it again because I definitely.
Okay.
So I was thinking that you said there's federal stimulus that comes in, that brings everybody up. Not necessarily people at the top income, they may or may not be getting stimulus. I don't know how that stimulus works. All right, I used to know. I'm forgetting how it worked. If that pushed everybody up, then for it to still be at so high at 586, does that mean that people who's beneath that number are making more? And then I don't understand how the distribution is beneath that number.
So maybe if we come back here, I think if we were to look at several years of this table, a couple of things you'd probably notice is that this state total amount and the amounts in all the buckets below, you would see that over time, those have also been increasing. And you would also see if we were to go from, looking at the 2020 tax year, 21 tax year, 22 tax year, you would see a similar run up in total income being reported, across Vermont. It's not to say that the only increase you're seeing is in this 1%. One thing that did jump out at me is that to be considered in that top 1%, during that time period, you did have to start making a lot more to be considered part of that cohort. And there could be numerous sort of explanations for that. During an initial dip when COVID started in the stock market, it had a really great 2 years. So a lot of people could have been benefiting from a run up in asset prices during that time. Another thing is during COVID, we did have a lot of people coming from their states, moving out of New York, Boston, who could work remotely and could themselves be high earners and who are then becoming domiciled in the state of Vermont, becoming Vermont residents for tax purposes. So it's probably not one single explanation. There's probably several contributors.
So that's not the report, but I'm trying to find the report.
Oh.
Yeah. Sir, there was a hand and thank you, Rebecca.
So I
guess, could you direct us to any other reports that look at the texture of this a little bit more? I mean, I know our Gini index is increasing, which is a measure of income inequality. And so I understand that this is increasing. I think, to go to Representative Wazak's point, I think part of it is knowing if the increases are consistent at all levels or if we're seeing polarization of one. And you cannot tell this from that. And this number of people is so small that we don't even know who these people are. If 500 people moved in from New York City and declared residency in Vermont during the pandemic and now they're moving out, we wouldn't even capture that.
So I don't know if we have a report, but that's obviously material I could prepare for you. That wouldn't be, I mean, if we just want to look at sort of, the simple sort of thing we could just look at is comparing how this table, which includes the entire spectrum, looks over time and like focusing on some of the specific income cohorts and what their income is looking like over time. That's something if we don't have a report, I could just do that for you.
And then we're gonna have a bunch of folks in tomorrow for testimony, who might not have that at the Vermont level, but have a lot of information about the federal picture. Representative Maslin, and then we're gonna finish this presentation and go to yep.
Yeah, thank you. One of the things that we heard a number of years ago when there was questions about wealthy people moving into Vermont to pay taxes, and I don't know whether this changed or not, that a number of people moved into Vermont with high income, but then retired. So that their income did not continue as high. And it's relevant in our discussion, and I don't think if there's an update. What you presented is good for now. Thank you, but
There were certainly people of all walks of life who moved to the state during that time.
some retired.
And some retired, some are still working.
What I see in this data, which I think is different than last time we had this conversation, is that the bump in revenues and income, like higher income tax thresholds that we experienced during the pandemic seems to be lasting. And at the time, we weren't sure if it would or not. So that's an interesting piece of information that I see in this. Yeah. Let's try to finish the presentation.
Okay, so the next few slides we can probably get through relatively quick. It's just,
I'm gonna interrupt one more time. I heard a rumor in the hallway that this is like warned for a vote on Friday. It's not. There's no vote warned on this. Okay.
Thank you. It's helpful to have a little framing.
yeah, so again, there's just some line charts that are really just depicting what we saw in the previous table. Just for reference for you all, showing just the number of returns that 1% represents, slowly growing over time. The income required to be considered in the top 1% as it grows over time. Again, you see here that more significant run up during COVID to be considered part of this cohort. There is a chart in here showing how the total AGI and sort of what that share of AGI is in this context of the whole state, how that's changed over time. Again, this is one that you see has been relatively stable in percentage terms. But obviously, when you look at total AGI, the overall income being represented by that 1% has, had a bit of a run up, particularly starting around COVID. And similar type pattern when you think about the percent and amount of taxes that were paid by this cohort. In percentage terms, that's this relatively flatter line that's been a little more stable over time. But again, when you look at it in pure dollar terms, that COVID spike in terms of taxes paid from this cohort happened around that time.
So just to clarify, the people who are now captured in the 1% could potentially even be individuals who weren't in Vermont previously.
Yeah, there's movement in and out of the state.
We have no idea who they are. Is my point.
And so the next couple of things I just want to talk about, which kind of got it, I forget who asked the question about, or I guess Representative Holcomb, I think it might have been you, just thinking about who are these people, who are these high earners. I have a few slides about the age of some of these taxpayers. So if you're thinking about, and the cutoffs here based on the reports don't line up exactly with the 586,000 cutoff, but 500,000 and up in income is about 4,400 tax returns. That's about 1.3% of total returns, 19% of AGI, and 33% of total taxes paid. That's similar to what we saw on that previous table. But specifically, I want to look at next here those individuals that are 65 plus, those tax returns that are 65 plus. So 500,000 and up for this cohort represents about 1,400 tax returns. That's about 0.4% of total tax returns, but it does make up about 7.5% of total tax returns. And they're contributing about 13% of total income taxes paid to the state. Now, Why is that important? You know, these are individuals who are entering retirement years of their life. And that is a cohort in Vermont that's it has been growing and is about to grow quite a bit. I just want to give a very quick plug to Ted Barnett, who you all know. He published the demographics issue brief yesterday, and which was great timing because I was able to yank out a couple of charts from his report and put them in here because I thought they might be relevant to the discussion.
And folks, we can maybe have him in to go through that next week if that's all.
So what we're looking at here, so the blue line represents 2020 and the green line is representing 2024. And what I want everyone to sort of look at here is this little bubble that you see moving through the ages 55 to 64. And you know what that's telling you is there are a large cohort of Vermonters who are approaching that, you know, traditionally considered retirement age. And so when you're thinking about how much income these individuals have and what portion of state revenue collections they have, you know, an aging population, you start to think about, well, if we're relying, well, a lot of these people are approaching retirement age. What does that say about sort of the consistency or how broad is the base of taxation we're talking about here? Because if a lot of the high income earners are concentrated in those older individuals, there needs to be a sort of cohort coming in behind them to sort of make that income consistently relied on when talking about stable tax, the stability of personal income taxes, right? And again, here's another representation from that report of how this has changed over time. You look at, so that 65 to 79 bucket in 2000, that about 16% of Vermonters were in that age cohort. Now in 2024, that's increased by almost 2%. So it's now representing about 18% of Vermonters. And then, yeah, likewise, the amount of individuals who are ages 80 plus, another age cohort you see increasing. And conversely, that 55 to 64 cohort, you see that decreasing from 15.2 to 13.8. That's what's driving, you know, the big run up in the sort of age cohort that is sort of traditionally considered retirement age. So I'm really just showing you all of these to sort of give you a sense of thinking about who in Vermont is paying income taxes and what are our demographics look like now and going forward when you think about sort of the base that you're relying on for a lot of these income taxes, right?
No, she's just whistling, representing.
I understand substantive reasons why you would break the cohorts this way. Did you also break the cohorts into equal bands? Ever in any of those, in that report? I haven't had a chance to look at it yet.
It's Ted's report, so he can.
Okay.
Go ahead, yeah, sort of. And this last one, again, from the report, it's just comparing how Vermont's population distribution compares nationally. So again, so nationally, about 13.9% of the population is those aged 65 to 79. And here in Vermont, we're closer to 18%. This I thought more was just sort of interesting context really than anything else. And obviously, if you have Ted, I'm sure he'll have some more expansive thoughts. Okay. Next, I was going to just talk about some other states. This is a table that shows the top marginal rate in every state. We've said this before, but remember the top marginal rate doesn't tell you the whole picture of the state's income tax code. Very little.
Remarkably little.
But I knew that I would get a question of how does 13.3% compare nationally? And you can see from this table that is equal to what in California is their top marginal rate of 13.3%. I will note their top marginal bracket for married filing jointly starts at about 1.4 million. So a little bit different base there. And then this next chart is a reiteration of something I have used before, but it is comparing the income tax brackets of New England and New York put together. And this green dotted line is what the new top bracket would be in context of other states in our region. But you know, in some cases, you see it's higher here. It's a little squished down here towards the bottom, but you know, a lot of a lot of those income levels at those lower levels, there are certain, you know, tax credits and deductions that are available that maybe not every other state has, right? So again, it tells you the top rate is going to tell you very little about the overall structure of a state's income tax policy. Okay, so here's what all four of the different brackets will be updated to be. You can see the married filing jointly here. That was the number I keep referring to as representative of the top 1%. And then the other filing statuses have been sort of proportionally increased their top marginal bracket based on what the increase in the married filing jointly bracket would be. And yeah, estimating about $114 million in additional revenue starting in fiscal year 28, because this is effective for tax year 27. And I guess I will pause with that because that was where it stops before we jumped into my investment proceeds tax.
Whoever wants to go first. Jim.
Right, you asked a question which is pretty obvious on your charts that I appreciate. Looking at the 55, 65% of taxpayers, you asked where's the cohort that's coming along behind, and this is a message we've heard in this state consistently is where are the middle income, I guess we could call them workers who are gonna, we would hope, build the tax break going forward, the tax brackets going forward. We hear this frequently from the governor and other people, and I'm just reminding myself that I just heard you say what we hear from various parts of the administration and other people. This is a big question. I don't
mean to, if I said something that maybe implied like policy feeling about something, that wasn't intentional.
You didn't say that.
Okay.
Thank you.
Pat, can you just on that slide we were just on with the four brackets? Can
Yes.
you just remind me about head of household and what that means?
Yes. So single, generally, you're not going to have any dependents. Head of household, it could be like a single parent, for example. Yeah.
Great, thank you. Okay. Kirby. Folks, we have 30 minutes left in our morning with Kirby through the language. After lunch, Jake is coming in from tax to talk about this, but then we can have Kirby come back after Jake if we still have more follow-up with Kirby.
Sounds great. One of my colleagues likes to say, I'm still Kurt Keegan, I'm for the council.
Say that about you?
No, he says that about himself, that he is Kirby.
I've thought about saying I'm still John Gray or something like that, but people wouldn't get it. Finding the document.
That's the best.
Give me a whole pocket.
I got some too, I think.
If you don't mind, getting in charge of any ideas of.
Tried.
It's on, no one usually gets quickly. Point three. I'm gonna apologize.
Okay, got it.
Sideways with the elevation, but.
Yeah, don't apologize for taking care of yourself.
Turning back on here.
I'm not turning my back on it. Oh, no.
All right, document. Yes.
Maybe a wee bit bigger.
Okay, so yeah, I don't think hopefully we won't need the entire 30 minutes so that we have left here. There's two major sections to the bill. Both are as drafted effective for 2027. So not retroactive changes, unlike some of the income tax stuff we look at. As Pat was just saying, you can just see these changes to statute. Before I show you that, I want to remind you, you'll see numbers that are crossed out and replaced. That is because whenever we change the income tax brackets in statute, those do not get changed frequently. I think 2003 was the last time. So most of these number changes are based off inflation. They do reflect the tax code as it applies in Vermont today. We update it.
So to confirm, these are not policy changes.
These are not changes. These changes reflect current law until you get to the bottom for the new highest rate. So the current highest marginal rate is here. So this is just background info for you to know. It's 8.75% on income over 312,000 is current law. The new proposed rate that would be this part. This is we're looking at married filing jointly at the moment. The new part is what I have highlighted right now, which would be for taxable income over 625,000. The marginal 3.3% rate would start applying. Page 2, line 10. So those are the things to know about the rate changes when it comes to the words on the page in the statute. Again, looking at head of household, which is the second category in statute. Change is at the bottom. Everything above that reflects current law. And these are the same numbers, hopefully, that you just saw in Pat's presentation. So for single, it would be taxable income of 481,825. Marginal rate would start at 3.3% for income over that. And then for filing separately, it's half of the married jointly, so it's 293, 325 is the threshold at which the marginal rate starts.
So Kirby, our top marginal rate currently is the 8.75, correct? Okay, thanks.
To keep things balanced for there's a fifth number here, we don't talk about it much, but there's the estates and trust brackets. I would just note that that's also included here for a 3.3% rate to keep it even with the other categories. It's the threshold for that is just double the next lowest. In this case, it's not. I had mentioned that for the other filing statuses, it was based off of more or less 1% income earners. In this case, it's just doubling it to have that new bracket. And those are the income tax changes for statute.
And you said 2003 was the last time they were updated in statute?
Yeah, I keep saying that number, but you can double check, but
It's been a
pretty
long time.
pretty certain that's it. That's it. The date.
And then the investment proceeds tax.
Investment proceeds tax. So for this language, we're starting on page 6. It would add a new chapter It would come, it's placed right before chapter 151, which is the income tax. It's not in with the income tax because, as we've said a few times now, this is a different new surtax. It is not an extension of the income tax. But uses some of the same concepts and definitions, especially when it comes to federal definitions for income tax. So the first part are the definitions. So there's a definition for federal modified adjusted gross income. It uses the same definition as the net investment income tax at the federal level. We have a definition for investment income. That is also the same definition as the net investment income tax, except adjusted under this language with those additions and subtractions that we talked about in the presentation earlier. And then there's a definition for threshold amount. In this case, threshold amount means those MAGI thresholds that we talked about. And they, for this version of this tax, Vermont tax, we're again using the federal definitions for and what those MAGI thresholds are. The next section is the imposition of the tax. As you see, the language lays out the thresholds like we talked about, 200,000 for individuals, 250,000 of MAGI for married, and 125 for married couple separately. We haven't talked about it much, but the VIP tax would also apply to estates and trusts. And in this case, we're following the federal law and treatment about how it applies to estates and trusts. Subsection B on line 8 is the imposition of the 4% rate on the lesser of investment income for the taxable year or federal modified adjusted gross income for the taxable year, and then reduced by the threshold amount. Threshold amount being those 200,000, 250,000, 125,000.
All that's included in the bucket that's subject to this surcharge is surtax is what's above the threshold.
Yeah, exceeding the amount exceeding those thresholds. So this is the legal phrasing to say.
So it's sort of like a marginal inclusion. It's okay. I motioned, but you weren't looking at my motion. Sorry to not use words.
Just a curiosity, so for the brackets, you know, we have it separated, single filing jointly, head of household filing single. In this, the single and head of household are both linked to the same threshold of 200,000. I'm just curious as to, was that like a conscious thing or was that just mirroring what?
It's to mirror the federal.
Okay.
Subdivision, so subdivision B2 is a different way of stating the calculation about thresholds for estates and trusts. It has to be done a little differently. In that case, it is the lesser, it's 4% on the lesser of undistributed investment income. So in this case, investment income that's been made by the trust, but it's still at the moment sitting in the trust because it hasn't been taken out of it yet. So as that investment income accrues within the trust each year, it would be like the trust is making the income for that year. That makes sense? Or the dollar amount at which the highest tax bracket begins for the taxable year. So the highest estates and trusts federal tax bracket. The threshold amount, in other words, the amount that you take off for the for a threshold would be the amount that the highest federal tax bracket is for estates and trusts.
So as I understand it from earlier today, this provision would have a big impact potentially on basis. If they're not. Money is put into a trust or something with a certain value.
Mhm.
And it increases over time. So the fact that it's increased over time, but it hasn't been taken out of the trust
it's still getting at realized gains. Like, so I don't want there to be any confusion about that. It's only about income.
Okay, okay.
In this case, you know, you have to say undistributed because that's kind of the trust's income. Once it gets distributed, that's someone else's income.
Okay,
Does that
seems
does that make sense?
I'll cogitate on it. Thank you.
Yeah, I know. So we have the provision in sub C that makes very clear this is a surcharge or a surtax. And we have a provision for allocating for part year non-resident individuals in sub D. So you can think of it as when it comes to allocation, when you have to allocate income when a person has income outside of Vermont and inside Vermont. The concepts that we use for personal income tax are what's going to be used in this. So if under the personal income tax, if something's considered income outside of Vermont, then Vermont wouldn't tax. That's how it would be done here also. But if you're a Vermont resident, a lot of things become taxable as being a resident, just so you're aware.
Representative Roby?
Sorry, so I think I don't understand this. If it's a non-resident individual, state or trust, but actual
Yeah.
individual. I didn't think they were paying.
If a person's a resident, name a state, California, and they own property, in Vermont, they own a house in Vermont and they sell it, that's Vermont.
And then also, if someone is a resident of another state and works in the state of Vermont for large periods of time, they would also owe income taxes in Vermont. I think I really want to spend like just a moment on this because the broader perspective outside of this room is that folks who are not full-time residents don't pay any income taxes in Vermont, and that's not true. And so I just want to make sure that we like pause on that point for a minute. It's easy to forget, but it's partial tax responsibility is like a very normal part of taxes from state to state, unless you're New York State, in which case you hoard all the money. Onwards, Kirby.
Onwards, so this is determination, we have a section determining Vermont and investment income. This matches the checks in the slides about how to calculate what that means. You start with the federal definition, as we said in the presentation, and all the things that we talked about in the presentation that is part of the tax base at the federal level. That's captured by this part of it, by the reference to federal law. And then we have the increased by, which are all of those bullet points we walked through about these policy choices for you to determine those separate pieces. So I walked through those separate pieces in the slides and described what they were. This is a less understandable version of that. But like sub B, for instance, this is the reference to the qualified small business stock. So if you want to add that back, that's the language that subdivision B is covering. Subdivision C is the opportunity zones and on and on. But these are the things we talked about.
Yes, Teddy.
So increased, the extent that they are excluded, is just a fancy legal.
Increased by, you're gonna take what's considered net investment income at the federal level, and then you're gonna add to it these things. So this increases the tax base for the Vermont tax.
So another way to say it in plain English would be, despite the fact that they're included, we are adding.
Nope,
Okay.
these are not included federally, but we want to include them. Would be a plain way to put
That's
it.
what I thought. Thank you.
Explain which
You're missing.
Representative Roby?
part, can you please explain A, B, C, which thing it relates to, like, which one is which one is which?
I'll try my best. The first one is like bonds in other states, income from bonds in other states, things like that. The second one is, what did I just say? The qualified small business stock exclusion at the federal level. and it's excluded from the federal net investment income tax, but we're saying, no. We're gonna apply those gains here. Opportunity zones is the third one. The fourth is the disposition of property held or trade in business that's not described under federal. So federally, it would be considered active income. But it's when you're selling property from business.
So maybe my concern before it's not a concern there, because if you're actively running a business and then you sell it and hope that that will be money you can count on in retirement, then because you're actively managing it, then it's excluded, then it's not going to be subject to the.
Under the federal version of the net investment income tax, if you're running a business and you sell, that would that's put into active, and you sell property from your business. So you own 5 buildings, you sell one of them. That could end up in, asterisks here with like this stuff gets very complicated. And so I'm just trying to tell you for purposes of understanding. You could sell property and it ends up at the federal level under the bucket of active business income, which so the federal net investment income tax would not apply. This subdivision is meant to say, actually, we do want to consider those things investment income for the Vermont tax. So that's the fourth one. The fifth is
Harvey, will you give us an annotated version of this at some point? Thanks.
annotated version of the whole thing. Or just
So all the cross references, just like a little, they are.
the annotated version is what we went over earlier.
Great.
And I am currently, and I can just share all those bullets that we went over. I'm pulling those up right now for my own sake. The next bullet would be the amount of gain that's not subject to the net investment income tax from the disposition of a partnership interest or S corporation stock.
Okay, that's E.
That's E.
Yes.
So the reference there is to those federal exemption for disposition of partnership interests or S corporation stock. That's what that reference is. And then F is the net unrealized appreciation in securities of an employer contribution or an employer corporation in certain retirement accounts. Which, if I'm following today's discussion, is the ESOP stuff that Pat was talking about, right?
Do you believe you are following today's discussion?
Yes. And then the last one speaks for itself. There's no reference there, but that's the incomplete gift non-grantor trust situations where federally it might be considered not your income because you've given up rights over control of it using this trust. But Vermont would be saying, we think that that's still your income because you have some control over that money.
Representative Holton, talk a little bit about the impact of that. I guess what I'm wondering, I mean, everything we do is incentivizing a behavioral response. And I'm thinking, going back to the case of a person with an adult child with a disability. If this passed, how would that affect how they chose to provide for an adult child with disability?
If they're trying to use a trust to do that, it has to do with specifics in setting up the trust. And if you set it up where you are clearly giving up more control and so then like technically legally it would not be considered an incomplete gift non-grantor trust, it could be a complete.
Okay, so if you
Trust.
completed the gift and there was a trustee that managed it, then this would not apply.
If you're giving up full control and it would then be considered a different type of trust. And
And you could do that by saying this trust can only benefit Joe Smith, Mike.
And Yeah, I think that if you're interested in this topic, it would be something for us to do a deeper dive on. I have not done a deep enough dive yet myself. But it could be worth taking a deeper dive and seeing how that plays out, because I don't know all the ways, but I do know there's a point at which it's no longer, you've given up enough control where it would not be considered incomplete gift on parental trust. It would be a different type of trust.
And we just somewhat coincidentally have a trust bill on Friday, and so we took a bunch of trust testimony yesterday, and we can take more on Friday, and then Representative Holcomb, as they fit together, we can get more testimony, just let me know.
And it's possible some of your witnesses on this may know more. And so then we're still talking about for the Vermont tax base, the additions and subtractions to the federal base. So this last part under sub 2 on page 9 are saying Vermont will not apply this to things that Vermont can't tax.
Well, not what?
For there's for instance, in the federal tax base for this, for the federal version, investment income from federal bonds could be included in that. But Vermont would not consider that investment income when we're calculating, do you meet the thresholds and what do we apply tax to? We will not be including that in, because we can't.
Because
Because federal law says you can't.
we're repeating federal law.
Yeah. We're saying we're gonna follow federal law. Yeah. For tax administration, there's just a quick provision that references the income tax. And so when it comes to deficiencies, assessments, refunds, appeals, enforcement, all of the many things that could come up, the income tax street or the income tax provisions on that will be followed. And that's it. It's a case of the thing itself being probably way more complex than the actual drafting part of it.
I feel like that's been happening. I feel
Yeah,
like
a lot
all
of-
our bills are either very far in one direction or very far in the other direction these days. So, thank you. Representative Higley and then Odie.
This may be a question for Patrick, but so the effective date I'm looking at, but on page 4 of Patrick's.
He addressed that. I think he was adapting his presentation from other proposals that have been made, and it's just, it was, some of the other proposals would have had it effective sooner, but the language you're looking at has it effective like this.
Thanks.
No, Odie, do you still have a question?
No, I'm gonna wait.
Okay, cool. Perfect timing. We are done for the morning. We are back here after the floor. We'll hear from Jake. Kirby will not be here because he'll be in Senate Finance. And